Appraisal of REO and foreclosure properties. Page 19, you passed the quiz. Remember, generally speaking, default usually happens, remember, early in the life of the loan. Number 3, REO stands for, remember, real estate owned. Page 20, lenders sell money.
Lenders sell money. It is a time-honored stereotype, popularized in movies, books, television shows, and songs. The evil banker, snarling and twirling his mustache, sits waiting for the property owner to miss just one payment so that he can foreclose and take title to the property. Like many stereotypes, this characterization is not accurate at all. The bank does not want to own property. Lenders are in the business of selling money. Their product is money, not the ownership of property. Ownership places significant burden on the property holder because it requires cash outlays for maintenance, insurance, taxes, cost of sale, management, and security. The lender usually does not want to take on the cost burdens associated with ownership of the property. According to the Mortgage Bankers Association, MBA, the costs that lenders incur in acquiring and disposing of a REO property typically include lost payments, taxes and insurance, maintenance costs, lost servicing fees, costs of collection efforts, legal costs, administrative fees, property repair costs, real estate commissions, difference between owed amount and sale amount, sale loss. Lenders often make great efforts to avoid ownership of the property and its associated costs through loan workout solutions and other means, which will be discussed in Chapter 2. End of page.
Page 21, carrying costs.
Carrying costs. It has been estimated that the carrying cost of a property is 2 to 4% of the overall value of the property per month. If the value is $100,000, the out-of-pocket expense is between $2,000 and $4,000 a month. And the longer it takes the lender to sell the property, the more those costs add up. Freddie Mac has stated that the cost of a typical foreclosure is slightly less than $60,000. Other online sources estimate this figure at almost $80,000. Officials at HSBC North America state that their average loss on a foreclosure sale is 20 to 25% of the loan amount. The point is this: foreclosure does not solve the lender's problem. Some housing advocates and community groups have wondered aloud why lenders even continue to foreclose on homes instead of providing automatic loan modifications or aggressively pursuing other loan workout solutions. Alas, this debate, timely and topical as it may be, is beyond the scope of this course. End of page.
Markets and price levels.
Markets and price levels. Traditionally, there has been a misconception that foreclosures only occur to lower-income borrowers and are only found in low-value neighborhoods. The national foreclosure situation over the last 15 years has driven home the point that foreclosures occur in all markets and at all market levels. They may be less noticeable at the higher end of a market because owners tend to be more economically sophisticated and have either a greater understanding of available workout solutions or have access to competent advice from appropriate experts. Several years ago, a study in Ohio indicated that there is a relationship between down payment and credit scores and foreclosures. The lower the down payment and the credit score, the higher the incidence of mortgage default. Thank you, Captain Obvious. Since default tends to happen early in the life of the loan, the borrower's payments to date have not yet paid down the loan's principal balance in any significant way. Because there is little or no down payment, there is little or no equity and no room to sell without being upside down and having to bring cash to the table to sell the property and pay off the loan. And if the borrower had cash on hand, well, chances are they would just have used it to make their mortgage payments in the first place. End of page.